Singapore has upgraded its full-year economic outlook with the Trade and Industry Ministry raising GDP growth forecast to between 1.5 and 2.5%, up from 0 to 2%. But it warns the outlook for the rest of the year remains uncertain, with the global growth likely to slow as U.S. reciprocal tariffs take effect. Caitlin Ng with more.
A 90-day pause on U.S. tariffs, now extended through a trade truce between Washington and Beijing. That breathing space prompted businesses to front-load ahead of tariffs, with the manufacturing, wholesale trade and transport sectors lifting second quarter GDP growth to 4.4%. But the real challenge lies ahead.
The pace of growth in Singapore's manufacturing sector is projected to weaken in the coming quarters as the US's tariffs weigh on demand on global end markets. Growth in the finance and insurance sector is likely to be dampened by the weaker credit demand and lower payment transaction volumes due to fragile business confidence and tepid consumer spending.
The revised GDP growth forecast for 2025 now stands between 1.5 and 2.5%, still well below 2024's full-year expansion of 4.4%.
There's still quite a fair bit of uncertainty. There are still things that are issues that need to be resolved going forward. That includes, of course, the sector-specific tariffs for some of the products that we were talked about just now, especially from the Singapore's perspective.
Now, uncertainty remains a common thread in the economic outlook. For one, the US's proposed tariffs on transshipped goods. Now, MTI says that Washington's concerns center around the false declarations of shippers, and that its definition of transshipments differs from other countries, including Singapore. Now, because of this, it says that it's too early to speculate on how these proposed measures could affect local sectors. Analysts say this, along with other factors, will lead to some modest slowdown, especially in the last quarter of the year.
What we may see is that inflationary pressures start to kick in as this temporary downturn stabilizes due to the fact that when the companies come and renegotiate for the new terms, the prices of all the goods may have risen due to all the tariffs, also due to the increased cost of production, perhaps also due to some cost of shifting production as well.
Still, MTI says it might be too early to say if the economy will tip into a technical recession, as all eyes turn to how trade tensions and global conditions evolve in the months ahead.
As for key exports, analysts say that could slide into the red for the second half of 2025 after front-loading activities dissipate and the U.S. tariffs take effect. Now, this despite non-oil domestic exports clocking a better-than-expected growth of 7.1% in the second quarter. Exports for non-electronic products grew 6%, boosted by non-monetary gold, specialized machinery and structures of ships and boats. Electronic goods marked a fifth straight quarter of gains. But Enterprise Singapore has kept its full-year forecast for key exports between 1 and 3%, citing lower demand from key trading partners.
It's still unclear for now what exactly will be the timing for the semiconductor or the pharmaceutical exports tariffs at this juncture. But on the electronics front, we have seen that some semiconductor companies are being exempted, provided that they commit to onshore some of the production back to the US. So it does look like there is some carve-outs or some firm level kind of exemptions that may be allowed. So whether this will also apply to the pharmaceutical companies is not clear yet.
For more analysis, we're now joined by Barnabas Gan. He is Group Chief Economist at RHB Bank. Mr. Gan, welcome to the program.
Hi.
So U.S. reciprocal tariffs are in effect. What are some global headwinds that you are anticipating?
So I think, unfortunately, as of now, there are more bad news than good news. And probably this is not a nice story to tell on the news. I think essentially we are much worried about probably the three T's in the global economy. The first T is tariffs. The second T is geopolitical tensions, T for tensions. And last but not least, probably it's the tighter than expected monetary policy, or more so the lack of rate cuts in the Federal Reserve, if anything. And that has actually been things that be keeping me awake at night. And probably these are the key risks that the global economy will be facing into the course of this year and if not next year as well.
These three T's that you mentioned, tariffs, tensions and tighter monetary policy, do you think they will have a drag on investments and business confidence beyond key sectors, such as wholesale trade and manufacturing?
Well, the thing is that Singapore's economic structure has been largely concentrated in the external-facing industries, and that, as you have mentioned, wholesale trade, non-oil domestic exports and manufacturing. And this, the thing is that numbers are doing well, at least in the first half, but we must take note that a good part of the strength that we have seen in the first quarter has been due to front-loading behavior, whereby exporters or importers from the US have been trying to mitigate tariff risks and trying to buy more before the tariff comes into play. This basically means that the numbers in the first half might be inflated, but more importantly as well, there's something called a payback in the sense that there may be some normalization into the second half, especially when trade activity starts to account for the front-loading behavior that was seen in the first half, and that basically may give the drag in the second half from the external industries in the second half of this year.
And do you think then that a technical recession is on the cards?
It's always possible. In the sense that we have escaped a technical recession in the first half of this year, so that's good news. But the thing is that if we look at the latest MTI forecast of 1.5 to 2.5%, and noting that the first half of this year came in at above 4%, that essentially means that if Singapore's economy does expand by at the midpoint of 2%, between 1.5 and 2.5 is 2%. If it does expand by 2%, it essentially means that the second half growth has to be at 0 or lower. And that may paint a technical recession story, in fact.
And how likely are we to reach that very small margin? Yeah.
It's hard to say. As I said, there are more bad news and good news. The bad news is that Singapore's total trade to GDP is the highest across ASEAN. We have a very small domestic economy. And even though we are at 10% tariff by the US, and we are most likely, and encouragingly the lowest across ASEAN, but I don't take comfort from that. Simply because we are a small and open economy, and the second orders negative spillover effects on Singapore will be magnified given our economic structure.
Having said that, are you anticipating any bright spots or sectors that can help cushion the impact of a trade slowdown?
There will always be bright spots. Singapore has been very, very well positioned, in innovation, in high-tech exports. We are very well positioned in 5G, AI. Investors think of Singapore as, highly transparent and really offer very competitive tax structure. That's one. But I think more likelihood than not, probably from a more tangible point of view, might stem from the increased tourism numbers that we are seeing, not only in Singapore, but across ASEAN. And that basically may mean that tourism spending and retail sector might cushion, if any, against the shortfall in external demand globally.
So tourism is a bright spot, for the year. So we know that the government announced a review of our long-term economic strategy last week as well. How do you see the mixed signals from today's data shaping policy priorities to drive structural growth beyond short term?
I don't think it's a mixed signal, if I may add. That life has to go on. Be it whether there's tariffs or not. I think one clarity and one encouragement is that we have tariff, clarity at this juncture, and basically means that business can actually start to account for the tariffs and move on with their lives. But I think right now, with the strategies that have been planned by the government, Singapore has been in this strategy planning mode for the longest time. That's what makes us well ahead in ASEAN. And beyond Trump, beyond the US, and beyond tariffs, Singapore still have to be one of the highest competitive, economy, as well as to position ourselves to greater heights. And this is probably what the strategy is for.
All right, Mr. Gan, thank you so much. Appreciate your insights as always. That was Barnabas Gan, Group Chief Economist at RHB Bank.